Hello, my name is Mike Sinibaldi, and welcome to this week's video edition of Heard on the Street. In this edition, I'm going to once again focus entirely on the S&P. As most of you know, I'm currently working on my mid-year forecast. On Saturday, August 20th, I hope to have completed my big picture wave analysis of selected markets and present them in a video format. Given the recent global rout in equities, you don't want to miss this. The past week has certainly been challenging to say the least, and after the S&P downgraded U.S. debt, any glimmer of hope that traders had at Friday's close may evaporate. Since the May 2nd high, the E-minis have lost a staggering 194 points. Thursday's 512-point Dow and 60-point S&P loss was just part of the beginning, not the end. And it could get much worse. What if the market is unable to catch a bid come Monday morning? Watching the market's free fall won't be fun unless you're on the right side of the trade. Imagine the chaos and panic that may hit world markets. Obviously, everyone will be looking at how the Asian and European markets react to the news and assume that that's what will happen in the U.S. trade. While that's logical, markets often do what inflicts the most pain to investors and traders alike before moving in the direction that should be anticipated. With that said, what do the charts say? At the weekly chart level, I've updated the chart to reflect Friday's weekly close. Notice that the 2007-2011 analogy is still working well, and a slight bounce is due, as in here, and maybe the start here, which should be followed by another round of selling to the downside. There is a significance to the levels reached on Friday that adds to the bearish case. Do you see it? It's wave overlap of the 1213 area, wave W. Why do I mention this now? Well, there are some readers that might still be viewing the 2009 low of 665 as the start of a bull market, working an extended wave 1, 2, wave 3 must be shorter than wave 1, possibly ending here, working a wave 4, but now it's overlapped. But that count can no longer be valid as wave 4 would now overlap wave 1. So layer by layer, any remaining bullish bias is giving way. Dropping to the daily time frame, the head and shoulder pattern is clearly evident. Left shoulder, head, right shoulder, and the neckline, and the break of the neckline. Since the May 2 high, the move represents a $10,200 move per contract. On Friday, price reached my 1166 target that I called for during my July 30th call, the 1.618 measured target of the head and shoulder patterns, and most likely the wave 3 termination point. As such, the bounce that my analogy is calling for should be underway. Most probable targets are the 0.382 retracement of 1235.75 or the 0.5 retracement of 1258. As with the weekly analogy, head and shoulders patterns often retest the neckline, yet they are not required to do so as part of the proper identification of pattern. However, notice the neckline comes in right at that 50-point retracement of wave 3. So keep a watchful eye on these levels. And here are the subdivisions for the ES-057 continuous contract. Notice the slightly lower 1.618 multiple. Again, a wave 4 rally may be called for to the 0.382 retracement, which would be slightly different than the ES-1057 contract of 1233.50 or 1255.25 that also challenges the neckline. You might ask, why am I focusing on the head and shoulders pattern instead of the triple combination? Well, quite simply, the head and shoulders pattern is the most conservative of the two topping interpretations. Here, the head and shoulders pattern topped here versus here, the triple combination pattern at 1343.50. If you are new to the site and are not familiar with my work, I recommend you watch some of my previous videos and blog posts. The triple combination allows for further downside risk due to the fact that the termination point of wave B was lower than the 1367 head and shoulders pattern. I'm taking a more conservative approach until such time as a larger relief rally happens. While the triple combination and 2007-2011 analogy has served us well in staying on the right side of the market, the termination point of the relief rally will clearly assist me in determining the final wave labeling of the topping pattern. Regardless, the time to think about the short position trade was several days ago, and this market is severely oversold. In my opinion, traders should take prudent risk management steps to protect positions. Dropping to the 60-minute chart level, we can see that the market actually has made the first leg of a wave 4 correction, and that the likely termination points fit well into the current daily chart levels. If my larger degree labeling is accurate at the daily chart level, according to the rules and alternation of Elliott Wave principle, wave 4 should unfold in a sideways correction, as wave 2 was a sharp correction. Notice that wave C circle of wave 4 would equal wave A at 1234, which is also the 0.382 retracement of the entire wave 3. Also note the open gap could also be targeted before another round of selling. And finally, this key area between 1250-350 and 1332 falls within the span of the previous third and fourth waves. So the likelihood of a termination point for wave 4 exists between these levels. In conclusion, I cannot rule out the possibility of further downside risk. There may be some initial selling on Monday where wave B is not complete, but I don't think that it'll make new lows unless it's a fake out. Basically, an expanded flat correction develops, where we have wave A up, new lows, wave B completion, followed by a 5-wave advance, wave C, up to our target areas. As always, any revisions that require upside adjustments to my targets I will make prior to the market open. Of course, the one caveat that's on everyone's mind is the S&P downgrade of the U.S. debt and the market's reactions to this. Should it get ugly when the Asian markets open, and I believe that wave 3 is still subdividing, then I'll provide an updated alert. I hope you found this video helpful and trade safe.